Hi
Hello,
there.
hey everyone.
Mm.
All right, just welcoming some folks in. Last lecture, it's a sad one for me. But we have our office hours next week. So, hey Michael, it's been a while since we've seen you.
Hey
Hey,
everyone.
hello. You guys ever have one of those mornings where you're like deep working on something and then you have to like pivot your mindset to something else really quickly, and you feel kind of an jarred brain from it? That's kind of what I'm feeling right now. I'm working on this like huge SQL query for calculating NRR. Are any of you calculating NRR in your business?
Hey
No.
everybody. Sorry.
Hey, Paul.
How you doing?
Good. I was just asking, is anyone calculating NRR?
Yeah.
How are you doing it?
So we are taking the renewal base, and then I can actually pull up the formula. I do it all in Salesforce. I just have to use a bunch of roll-up summaries. And then I'm configured specifically to the FY. So my NRR calculation is the renewal amount plus any contracted amount plus any expanded amount divided by the renewal amount.
Yeah, so starting revenue plus expansion minus contraction minus churn.
Yep.
Yeah,
Divided
okay,
by
got it.
the renewal amount.
That makes sense. It's just like going crazy doing this in SQL because we
Oh
have
yeah.
we have HubSpot, and HubSpot that can't really do what the work that I'm thinking of doing. Yeah, I'll show you guys in a second. Okay, so why don't we get into lecture 10? But I'll show you guys a little preview of this crazy thing I've been trying to do for the last 2 days. Okay, I'll show you real quick. I don't know if you guys use BigQuery, but this is basically a huge SQL query I've been bashing my head on for the last day to calculate NRR from HubSpot. But it's finally doing all the math that I needed to do. If you guys ever want to learn SQL, you guys can hit me up. Happy to help.
Nice one.
I know my head hurts. Okay. All right. Let's talk about something where my head won't hurt. This is going to be an easy topic for lecture 10. All right. So we're going to go through a lot of the work that we're going to do during annual planning to support our CFO and our CRO. So and then afterwards we'll end with I'll go over like the landscape, the hiring landscape, compensation for RevOps roles, and then end with like putting it all together. If we don't get through everything, we can kind of blend into a special session in the office hours. But let's go over a couple of key metrics: customer acquisition cost, customer lifetime value, payback period, the churn rate and retention rate, magic number, and rule of 40. So who here uses CAC or has calculated their CAC in their business?
We use
All
it,
right,
but I'm not involved in putting it together.
okay. Della, I see is nodding her head. Cool. So in my business, you guys saw the SQL that you saw. I've connected our data to our finance and accounting systems. So I've actually calculated this as well using Tableau and SQL. But what it really is just really taking a look at your total spend on sales and marketing, and then dividing it into the number of new customers that you've acquired in the same period. Now, there are some variations of this. Some folks will put a lag. They'll take the spend from X number of days ago, depending on your sales cycle, to the period from which you'll normally acquire your customers. Some folks won't use close date. They'll use subscription start date. So there's a number of different variations on customer acquisition costs. But what you're trying to do is understand how much does it actually cost to acquire an individual new customer. And it's basically saying, this new one customer is going to cost me, $400,000 each. If my average price is 30,000, well, guess what? 30,000 a year, it's going to take me 10 years just to pay back year one. So that's not a great ROI. So you want to combine your CAC with a couple of other metrics, your LTV, that will give you a ratio. And you also want to compare it to your payback period. That will tell you how many periods of time it takes to recover that initial cost outlay. So when we think about your spend on sales and marketing, it usually comes in these forms. Salaries and wages, including fringe benefits, all the things that you add in, the technology that you spend, advertising or marketing programs, and then any contractors that you're bringing into your organization. Now, the largest spend is clearly going to be in salaries and wages. It almost invariably is. So when a company is looking to cut cost, if you really want to cut down your cost, there's two ways you can go about it in your personal life. You can cut the big spending items, or you can cut the cup of coffee that you get every single day. Most folks spend their effort on cutting that one coffee out of their day. When in reality, if you wanted to get your finances real tight, you get rid of the big item. It's the same thing with the salaries and wages. That's the big item. Technology is the small item. No matter how many times you run CAC, you're always going to find that your spend on technology is super small relative to your wages. So when a company needs to cut, it needs to cut their people first, which is the hardest thing to do, but it's the clearest way to drive operating margin uplift from your spend. But you'll always see business operations teams, finance teams hound RevOps teams to cut one license, cut two licenses, see what tool that we can cut. But when you're cutting tools, as I've always said in this course, you're also cutting capabilities. So it's a double-edged sword. So when we think about headcount and compensation, we want to break out the roster into its invariable parts. We did a similar exercise in lecture 9 with the sales compensation. We're doing the same thing here. We can take a look at how many folks, what their OTE is going to be, and then layer on a burden rate. I usually burden around 30-35% for benefits overhead. And that's usually because there's either 401k match or benefits or payroll taxes that have to be paid by the employer. I always just buffer 35%. So let's just go through an example. Let's say here the entire sales team and the marketing team is going to cost us around 340K. This is one way you can start looking at, it's 340K for the year. How much business what's our target, right? So, are we looking at 30 to 40% of your cost of your bookings to come in the form of salaries and wages straight out from the gate? When you look at tools, we'll want to start looking at getting an inventory of every single tool. We went over this in the tooling lecture as well, where you take inventory, multiply it by the users and the fees, and you can get a sense for how much you're spending on those tools. You can see here that the same org that you just saw in the previous slide was spending 340K, and here they're spending 130K, so a third of their salaries and wages on their tooling. Now that ratio gets smaller and smaller as the org gets larger, because you're driving unit pricing for each of these tools. And then we also want to add in the marketing tools. The marketing tools don't make sense from a headcount perspective. Usually you have these big expenditures for very few people in the marketing team. So I wouldn't look at the marketing tooling organization from a spend per headcount perspective. I would look at all in, how much are we spending for marketing tools? Then we also want to break out our demand gen and our programmatic spend. So if we get a sense for what our cost per lead is, our cost per opportunity, we can start backing into and projecting how much marketing demand gen budget we might need in terms of paid advertising to generate the business that we have, we want to generate for the year. So we take a look at their monthly spend. This is a 200K run rate. I've actually seen one company spend close to 250 grand per month. Insane spending. But they were closer to and we're close to 100 million ARR business. So when we take out all those costs, we take a look at, we're spending about 558K per month. We annualize that. That's going to get us to about 6.6 million. And let's say, for example, that we've acquired, 55 customers. This is just like dummy data. And what we end up getting is a math that looks like 134K for the CAC per customer. Now, this is going to make sense for an enterprise level business, not so much for someone selling to the SMB or to the very small business, because those ACVs are going to be under 10K per customer. So when we look at the lifetime value, we want to see, okay, well, what's the average revenue per year? And then how many years do we think each customer is going to be around for on average? So the LTV, and the easiest way to do this is to take your logo churn rate and invert that, dividing it into 1 and multiplying that by your average revenue per customer or average booking per customer. And that's going to get you your lifetime booking. That's on a nominal basis because we know that, let's say you generate $100,000 per year in bookings. $100,000 tomorrow is not $100,000 today, because you can take $90,000 or $92,000, put it into the bank, have it generate interest. It'll become $100,000 next year. So we want to try to collapse those values. If you're working with your finance team, you'll often find that they'll use a present value formula in order to collapse those dollars into one unified stream, one unified economic view in 1 year. Okay, so in this example, let's say that the average revenue per year is 110,000, and then they have a 20% churn rate, gross churn rate. That means the average customer is with the business for 5 years. That means on average, we can expect the typical customer to bring in about 550,000, and that's about a break even with the 553 for the CAC. So that's a 1-to-1 CAC to LTV to CAC ratio. And there's something that, go ahead.
Sorry, go for it. I think you're about to get to it now, so never mind, actually.
Oh, no, go for your question.
I guess actually might get to it, so I don't want to. So I think one of the things that, like, I'm just thinking about hypothetical for like for a lot of B2B businesses that have large contracts for many years, right? You can get to a math that's like, hey, it's a customer lifetime value of literally $10 million, and then, but in year 1, that's probably, I don't know, $500,000 of revenue. And it would be, I don't think you'd want a head of finance to say, hey, listen, I can spend 10 mil this year or 5 mil this year to get 500,000. So I guess the question is, like, how have you had that kind of margin versus customer lifetime value over CAC conversation? And then how much do you feel sales ops should be tracking? That's what I'm kind of thinking this might do it here, but I'm not sure exactly like how, like, in-year margin versus LTV CAC kind of thing.
Yeah. So the first thing we'll want to do is include margin, which you're doing here. The second thing you want to do is segment your business lines. So a CLTV or a CLV based on specific business units or specific products or specific regions. So for example, when you're in the United States and then you're launching in Europe, you don't want to blend those two together, right? Because then you're probably subsidizing one region of the world that's also more expensive to launch in. So let's say, for example, your business has been around for 4 years in the United States and you're now launching into Europe. Well, what should happen is that the customer acquisition cost in Europe should be more expensive than your American counterpart. But you know going in that it's going to be expensive for a couple of years, but not as expensive as if you didn't have the American counterpart and you're just brand new launching into you have some brand equity in your North American business line, and now you're launching into the US. Now, for your CFO, they're going to look at it as, well, if I spend $5 million now, I need to know that the revenue stream is not flat year on year. I need it to go up to compensate for inflation over time. You want that to come into factor as well. So present value is going to make sense. And the second part is you need to know your hurdle rate. You need to pay back the cost of developing the product, the cost of goods sold, right? Your gross margin. So this is the hurdle that we'll talk about now. So the modified version of this is to apply gross margin to your CLV. If you have a gross margin north of 70%, you're probably in a software business. If you're in the 30 to 50% range, you're probably in a 40 to 60%, you're in a services range. And then if you're below 40%, you're probably in some sort of retail or physical goods business. Now, the CLV profiles for each of those different margin profiles, very different impact. So what you're going to see here is a lot of what I think around kind of SaaS business with a 70-80% gross margin. So your lifetime contribution would be your lifetime value multiplied by your gross margin. This is going to give you the excess above the cost of goods sold that is now going to pay back your OpEx, your SG&A wages for sales and general administration down below. So now we take let's say, for example, that the margin profile is at 80%, which would be considered in the excellent range for software businesses. If you're below 80% in the 70s, you could be doing better, but some products just quite frankly need a lot more horsepower around them and higher cost CSMs also to throw in. So depending on how you scale your CX organization, it's also going to impact your gross margin because CX is considered part of your cost of goods sold for your software business. So instead of 550K for your LTV, you're now at 440K here. So let's go over payback period real quick. So with the payback period, this is the number of months that it's going to take for your customer contribution to equal your customer acquisition cost. So one of the easiest things that I do is take a line chart and start mapping out on an XY chart. When does the lifetime value cross the x-axis, which would be number of months, until the CAC is completely paid back. You can also use a formula. You can take the CAC divided by your average annual revenue, multiplied by your gross margin. That's your contribution margin, and multiplying that by 12. So in the example that we had here, 132K to acquire a customer, 110K per year with an 80% gross margin, you're going to see that this payback period is around 18.2 months. Now, if you talk to any VC that's out there, they're going to want you to have your payback period underneath 12. But there is an interesting curve where a Series A and B company, their payback period probably going to be in the mid to high teens. That's going to start coming down towards under 12 once you get to Series C, Series D. And then you actually see this very interesting trend that as businesses become larger, they start adding new portfolios, new markets, their payback period actually starts to increase back up again. And that's because they're now investing in new unknown businesses. All right, this came from Lenny's newsletter, one of my favorite newsletters to subscribe to. Talks about like what is considered good to excellent or good to great for different types of businesses. So the payback period for a B2C is considered excellent at the 1 month or first time purchase. That's a super high margin type product. If you're in the B2B space, you really should differentiate between whether you're selling to the SMB under 10,000 for your ACV to the enterprise, something in the 6 figures to 7-figure range. You want to get that payback period in either 6 to 12 months to be considered great, 12 to 18 months to be considered good. And then the example that I had, which you saw here, was 18 months for a pretty large ticket price. That would be considered good according to this table. Now, how we use this, I think a lot of revenue operators think that these are things that finance should worry about. In my mind, that's not true. The CRO and the head of RevOps need to worry about these ranges and start thinking about how can we improve these. Do we improve it in the form of decreasing customer acquisition costs, meaning higher win rates, lower sales cycles? That means trimming your ICP to just your core, limiting your experiments. Maybe it's working with product to make sure that we've identified things that we hear in the course of our conversations, creating what's called a voice of customer process that feeds back to the product team, and we can get on the roadmap. So how do we one, reduce the customer acquisition cost? And then 2, how do we increase the average annual revenue of each customer? All right, so when we think about the lifetime value piece, big piece of that is the churn rate. So we need to start looking at the difference between churn rate and the renewal rate. So in this case, I'm looking at, how many logos did we have at the start of the period, and then how many logos did we lose during that same period? That would be a churn rate. Another way of thinking about this is the close date versus the create date. If the close date is going to be kind of the renewal rate, and then the create date is a cohort-based view, and that's going to be your retention rate. All right, one other metric to look at is something called sales yield. This is a heuristic, a rule of thumb that you would use. And what it does is it tells you how many dollars does it take to spend to generate $1 of bookings, very similar to a burn rate. And here you're going to take your CAC divided by your new bookings, and that should give you your sales yield. You want this number to be under 1, as low as possible. In the case that we've been doing the dummy math here, 1.22 for the customer acquisition cost divided by the new bookings. What I'll do is I'll give everyone a template that created all these numbers after the class is over, so everyone has that template. Okay, now we think about CAC, LTV to CAC. So in the old days, I think the ratio that most folks would quote is 3x. But now we're seeing the bar raise a lot higher with a lot of these investors. They're looking for anything that's 6x and above for different categories. And that means you have real strong market traction in the form of high renewal rates. You also have, if you bake into your upsells and expansions, the land and expand motion for your LTV, you bake that into your LTV, which would be your numerator. And then you're also at the same time reducing your CAC as much as possible. This would get you to 6x or greater. I have operated in any businesses around 4 to 8x. I've been at one as low as like 1.5x. That business was clearly failing. But yeah, you can get the real sense for how the business is doing based on this ratio. Has anyone ever asked their CFO or their CRO in a job interview, like what their LTV or CAC is? Yeah, I have. I can tell you they stumble like crazy when you're they don't know. They clearly don't know when you're interviewing them. So they're interviewing you. You start asking them all these questions like a VC, and they'll look at you like, "Whoa, that's what I need you for. I can calculate any of this." All right, magic number. All right, so magic number, a way to evaluate whether or not you should continue to invest in customer acquisition or slow down. So it's basically saying, should I put more, should I put my foot down on the accelerator, or should I ease off a little bit? And the way to think about this is taking the current revenue, the delta between this quarter's revenue minus last quarter's revenue. So you're just getting that delta, you're annualizing it. So you have to have continual growth quarter over quarter for this to make sense. Can everyone hold on? I got a call real quick.
No problem.
Okay, cool. Sorry about that, everyone. Personal emergency. All right, so we were talking about the magic number. This is really taking the quarter-over-quarter growth of the business and then dividing it by the previous quarter's spend. So how much incremental revenue did we generate for that total marketing and sales spend for that quarter? What this should do is give you a couple of things. It gives you an idea of whether you should keep going, slow it down, or stop completely. If you're greater than 1, keep going. If you're less than 0.75, it's a sign of inefficiency. It's probably an opportunity to take a look at, okay, should we roll into this quarter with that incremental marketing program that we're thinking, or hiring that additional sales headcount? What do we need to do in order for us to get back on track with this magic number? I think this is a bit of a herky-jerky way of managing a business, but I think rule of thumb, quarter over quarter, you can kind of size up and assess whether you should hire all your heads all at once or kind of break it out into pieces. All right, so rule of 40. This is a healthy way of taking a look at you add in your gross margin and your growth rate plus your profit margin, your operating margin. If that is over 40, you're in good shape. If it's under 40, you're not in good shape. This is one way. If you're working at a VC-backed company, a lot of CFOs will actually put these numbers on a bingo board, and each quarter kind of assess on which way to keep going. All right. All right, so last one, we'll go over burn ratio. This is probably all the rage recently. It's pretty much a variation of sales yield. This is basically taking all of your spend and dividing it into your new bookings. That's your sales yield. And in this case, the burn rate is defined as how much money a company burns to create $1 of ARR. If you are over 1, that's not good. If you're 2 to 1 for Series A, Series B, it's still considered okay. If you're at 3 and greater, you're in the red zone. A lot of companies right now who raised in 2021, 2022 that have a significantly high burn ratio, they're at danger of not being able to raise money again, and probably what I call the walking dead. Okay, so when you get these slides, here's just a quick overview of the drivers between each of these metrics. If you're aware of what each of these numbers are, you don't have to calculate these as a RevOps team. I usually ask my finance team to bring me these. I have questions around like the specifics. Can you show me the data, how the math is mapped out? And that way it can help me identify where the problem area is, right? Do I have to work with product enablement, product marketing, sales enablement to translate all the goodness of our product into our sales positioning? If we're doing well in sales, but then we're doing terribly on the churn, then to me, it's around service, onboarding, implementation, maybe even my pricing. So these are the areas where we start to have some conversations around the strategy of the business and how we can go ahead and make some adjustments. All right, so I'm going to go into RevOps, the landscape. RevOps salaries have increased quite a bit over the last couple of years. This is kind of the ranges that I would expect for someone as you're climbing through your career. I think most everyone here is in management or directors or VPs. Everyone should be probably above 6 figures by now. If you're in North America, if you're in Europe, I know the salary ranges are a lot lower. Same with Australia. I don't have good benchmarks there. But what I've seen are head and VP of RevOps hitting the 200K mark here in North America. All right, I have some questions. Oh, thanks, Michael. All right. So these are the ranges at a publicly traded at a cloud company. This is AWS by just so you know. They have these like 11 different levels, level 4 through level 11. These are mid-level managers that you're looking at here, by the way. So these salary ranges are, in my view, like kind of crazy. You can see that the average company is on the right-hand side. Those are the ranges that I showed you in the last slide. But in my surveys that I've had with other folks at AWS, these were the ranges. They were paying top of the range for the lower end of their own salaries. And then they have a good 60 to 80K spread on top of that. So they have these salary bands. So I did a little bit of a tour of duty, doing sales out to these big cloud competing companies. Every time I went there, got a huge pay bump, and then moved my way back to startups because that's what I really love doing. I don't expect this trend to continue. I don't expect it to keep going up and up and up every year. I actually expect our salaries to stay flat from here on out for a couple of years, and that's because the cost of a RevOps org has just ballooned so much that CFOs are now starting to pay attention. So like, hey, this team here, they're a cost center, as it's kind of like they're perceiving RevOps as, is starting to become quite expensive. So you'll probably see this as you're hiring next year, as you're budgeting. If you lowball your budget, you're going to have a hard time hiring somebody because these ranges have increased so much. Is anyone hiring today for their team?
Nope.
No. Okay. Reaction to these ranges, by the way.
Average makes sense. Seems logical.
Yep, I agree. Yeah, the big tech companies, that's what they pay in that third column. The Facebooks or Metas of the world, the Googles and the AWSs of the world. That's what they're paying. There was someone 10 years my junior making like 250K per year at AWS. It's like crazy, and he was making 120 at the job that he had before that. This is absolutely crazy.
Do you adhere, Jeff, to the mantra of like you want to try to double your salary every 5 years? Is that like my brother was telling me that, and he's like CFO of Medtronic, but I just don't know if that's something that is like a reasonable expectation.
That's crazy. That would imply rule 72 divided by 5, a 14% can't compound annual growth per year. That's unrealistic.
Yeah, that was his goal anyway.
Yeah. This is my own personal thesis, is that you get paid more by leaving a company every 2-3 years because you're gonna get a 20-30% jump than if you grind it out at a company. But that's generally also bad advice because you're hopping so much that you put a lot of potholes in your resume. But I think companies give you the raises when you ask for a promotion, and you position yourself when you negotiate your success ahead of time. So you let people know, like, here's what I want to get to. Here's where I believe where I am. Here's what I think I need to get to. Let's create a personal development plan, a coaching plan for me to get from here to there. And then let's work on all the things that I need to get to achieve that, and then try to achieve more than what's on that plan. That way it becomes incontrovertible evidence that you're on your path to promotion. But yeah, I think it's interesting. Doubling every 5 years, I would say it's probably fair to double every 7-8 years, right? Because that would bring you to an 8 to 10% compound annual growth rate. And I don't think it's unrealistic if you're getting promoted every 2 years, right? So you might get like a 3%, 5% raise year on year for just keeping up with cost of inflation. And then you get promoted, and that promotion should give you a 20% pay bump, and that would wash out the averages between those 2-3 years.
Thanks.
That would be my thinking around it. Okay, so let's go through some training around, like, if you're managing a team or if you yourself are thinking about how do I get promoted to the next level. This is what I give to my team. It's like, okay, well, here's why you would join the team, with Jeff as your leader. And I myself, as an IC or a leader, I also want to get to the next level. So when I hire someone who's an SDR and they're converting to RevOps, I don't expect them to know everything. They're basically straight out from school, or they are straight out of school. This is a level 2. I'm really looking for just high appetite, high hunger for learning, curiosity, and someone that's going to run through walls. I just need someone that's going to just work their ass off. That's what I did in my early days. And this person's got to be a sponge. So I can't fill my team with all level 2s, because then I'm leaving the org in a weak spot. And so I like to sprinkle in someone in the layer. You'll get to see the other levels, but hiring the other levels first, and then start building out the bench with level 2s. Wizardry. So now we just hired someone who was like high hunger, high appetite, high curiosity, but now I need them to not just be hungry and curious. I need them to be a master of some sort. and a technical master. The technical master doesn't mean to be technology. They could be great at comp plans. They could be great at modeling. They can be great at building project plans. They have to have some sort of level of expertise within the business, which I can go to them and they're actually teaching me, because I quite frankly don't know my way around that technical skill set as much as they do. I lean on them for that expertise. Then I get to level 4. It's not just about executing really well. It's about providing the insights. It's about going beyond the numbers and telling me a story, the narrative. How does it fit into the overall business context? And not only are they giving me the responses when I ask them for it, they're actually coming to me well ahead of time and they're telling me proactively. Also, their communication is to a point where I could probably confidently put them in front of the executive team, and the executive team has very few, if no, feedback or comments to me saying that person right there is a rising star. Keep tabs on that person. That person has to stay in the company. That's the type of person I'm looking for when they're moving from 2 to 3 to 4. And once they get to 4, I'm starting to think through, okay, now they're getting to probably a manager level. Level 5, what does this look like? This is solving problems for other people on my time, on my behalf. So for example, I have, as a RevOps leader, I have multiple stakeholders, the head of CX, head of marketing, head of sales. There's a big meaty problem that traditionally one of those heads would have came to me for to handle, and then I would have had to delegate. But instead, this person is now identifying those problems, solving them in a way that is not just solving the issue, but also providing great communication. And I'm now getting feedback from that stakeholder telling me, that person on your team actually solved my issue. And for me, that's just a feather in the cap to know I've got someone that's a kind of a senior resource on my organization that's going to be able to handle this. I once worked at an org where I had 5 RevOps team members, and there was one person that I always leaned on, and he would always solve things super quickly. And I remember telling him, you don't have to solve it quickly. That's not the hallmark of success here. I need you to solve the right problems in the right order, and having your stakeholder feel confident that they've walked away with a solution that's going to stand the test of time. And so that really reoriented how he thinks. And I was able to promote him twice over the 2 years that we worked together. And he's now head of RevOps at another startup with a team of his own. And I think a lot of the lessons that, when I go out to drinks with him is that feedback that I gave him. He's like, I would always thought that it meant, crossing things off my task list and just, getting that down to 0 as fast as possible was a sign of success. I was like, that's not what I hired you for. I hired you here to solve real business problems, and business problems don't always come in the right order. You have to do that reordering yourself. So once they get past that, now they're driving big impact. And what I mean by impact is they're taking a huge, large swath of work. So for example, my enablement leader is taking on building out an onboarding and a continuous learning program for our reps, a certification program. And then our marketing ops leader is now working on ways to think through channel optimization, right? Before we were just launching these programs without having any regard for which channels are moving up or down. And so these are projects that are going to have large impact on the business over the long term. This is probably where most head of RevOps folks are, is at this leadership level. They're in charge of multiple efforts. You may not be able to take on every single item. You're dropping some things off the back of the bus. But here you have the opportunity to be in the room with the executives. And in order to get here, it's about proving all the things from 1 through 6, but you're also taking charge of initiatives that you yourself may have identified without having them brought over to you. Level 8, this is probably a level that I haven't been to myself yet. I had a taste of it. Level 8 is going to be what would be the equivalent of this? At startups, you probably won't have this, but at large corporations, you would. This person would be in charge of all annual planning for all of North America, right? With a $10 billion book of business. Now that would be kind of considered ownership. That person can easily leave that large company and become COO at a startup easily. All right, so my personal tips for negotiating your success. Doing your job well is not enough. I always think it's helpful to find sponsors or champions internally within the business that would advocate on your behalf when it comes time to fight for one of those few seats at the top of the pyramid. Rather than having someone define success for you, I think it makes sense to define what you think success looks like, get agreement on that with your stakeholders. Have everything written down in two forms. Your OKRs are already going to be there, your objectives, key results, but you should also develop a personal development plan that's signed off by your peers and your stakeholders. I personally have a couple of peers that I work with, and I'll meet with them every quarter and say like, hey, here's just accountable check-in. Here's how I'm doing. Here are the projects that I did. And these are folks that I know that don't work with me, but there are also other heads of RevOps. And, we're really thinking through, how can we be a personal board of advisors for each other? For my team that I manage, I'm always looking for, are they operating at the next level up? And then identifying trends each quarter for, where can I find an opportunity to demonstrate that I'm performing at that next level? So each quarter I have to progressively raise the bar. And what that looks like 4 quarters from now is a substantially different level of professional performance versus the year before. And so these are my tips for success. Now, if you have any questions for yourself as you're thinking through next year, set a one-on-one with me in the Slack channel. I'm happy to do a little coaching session with each one of you as you're thinking through the turn of the new year. All right, so some career paths. A lot of folks get into RevOps from like finance or SDRs, and afterwards they're like, well, I don't know what to do next. I'm not sure if I like this, or hey, I've been doing this for a long time and I'm not sure where to go next. There are a couple of clear pathways. And I think they span the range of being purely technical to purely functional. On the purely technical side, a lot of folks can move into the world of product management. I think a lot of what RevOps does is internal product management. We're building the ecosystem, the operating system from which employees use to execute their role and go to market. So in my mind, that's very much product marketing, sprints, using Agile in our workflow, building user stories. Like these are things that I think any product manager would do. On the other side is moving into the finance and strategy side of the house. You may not actually be complete finance or complete strategy, but I find that most folks stop at the business operations. It's kind of the next natural area. And that's where I've seen like Franco Enzini, for example. He's now COO at Lean Data. He was previously VP of RevOps at Malwarebytes. There have been quite a few RevOps to COO leaps in the last couple of years. All right, signals that it's time to shake it up with your team. You can read these, I'll skip these, but I think warning signs that I see are low growth to no growth. There's no career opportunity there. Or you were up for promotion and then someone was hired instead above you. That's also a sign to get some feedback. But these are a couple of things that I would look at, whether it's time to shake things up with your team or shake things up for yourself. But to each their own. But I think the slide around driving your personal success is the most important one. All right. So one thing that I like to do each quarter is take stock of all that you've achieved, and we do the following. Every quarter you have to probably fill out your OKRs for your department. But something that I like to do is go back in time throughout the entire quarter and really write a personal narrative around your achievements for the quarter. And you can use a STAR format. It's this thing that I use for interviews. But you should go over situation, task, action, and result over your 2 or 3 big initiatives. And that's going to give you a sense for did I set out to make waves in the business? Did I drive large impact? How did I do so? And what was the situation before that? This is going to give you the ammunition that you're going to need to arm your stakeholders with to advocate on your behalf when it comes to promotion time. Then next steps, it's what are the next projects that we should be working on, and should we go ahead and reduce any of the wrap up the projects that we have, and the impact that we have, for example, is you've you've driven higher velocity, you've driven higher efficiencies, that's a measurable level of impact, or you're now paving the way to allow you to measure in the next 60 to 90 days the impact that you're making. So these last sprint of the last 10 lectures, so it'll be like one shining moment month for if you watch college basketball. So we're going to go over a lot of the highlights for revenue operators. So putting it all together. First is the customer acquisition process. We want to map out the entire customer lifecycle end to end. We want to layer on a couple of different versions of this. We want to have a technology blueprint. We want to have the process handoffs. We want to have a single-threaded owner and owner responsibilities. Lastly, you want to have all the KPIs that you're going to need from stage to stage, and that's going to give you your conversion rates from which you can benchmark whether the org is getting better and better period to period. Now, even better, the role of the tenets of a RevOps org is to, one, build a team that's talented and diverse. I always think a diverse team lends to an incredibly resilient operations organization. So hiring folks that have systems experience, someone that has analytics experience, someone that's great at project management. If you can find someone great at all three, you have sort of a unicorn on your hands. That person is going to be very hard to replace if and when they do leave. Second, leading and executing planning activities for the business. It's September or end of September. We're leading into October. Many of you are probably already involved in your annual planning process for next year. Next is translating those business goals into go-to-market goals, meaning the initiatives. So we need to generate X% of revenue growth from this year versus next year versus this year. How are we going to get there? Is it going to be new versus expansion? If it's going to be new, where are we going to get that from? Is it a new ICP that we have to develop? Do we have the messaging behind it? What are those initiatives that we're going to have to create to execute our goals? Fourth, driving alignment across the go-to-market leadership team. I always like to think that RevOps leaders is a little bit like wrangling or herding cats. These folks kind of move in their own directions, and you have to be able to bring them all together into one room. Next is operating the rhythm of the business. We talked about operating cadences, setting ourselves up for success by bringing in the right homework into those meetings. So here, you're not a RevOps leader. You are a COO to the go-to-market department. Sixth, thinking about driving process improvement across the org on a continuous basis. And a lot of that has to be, where are the inefficiencies in our org? Where is our sales team spending entirely too much time on the administrative or the non-selling? And how can we move that towards selling, and especially to the direct side of the house, engaging with customers? You can do that through automation. You can do that through segmenting the team. You can have a deal desk team working on contracts. There's a number of different ways you can drive efficiencies for the org. Seventh, developing your eye for the prize. What are your key KPIs? What are each of the KPIs at the different levels of the organization? Building and designing the infrastructure that you're going to need from a technology perspective. And then lastly, holding the ship together. I showed that Spider-Man meme, I think in week 1, holding the ship together. All right, so other things that I think are going to be helpful. These are your tenets, things that are first principles for your org. So this is how I like to run my organization. I like to tell people these are our first principles. If we can't operate around these first principles, then we have to have something to stand on. The first is making sure that we have enough time to prioritize what's appropriate. So as a leader, I'm thinking about how to appropriately reallocate time across my team in order for them to have enough capacity to tackle what really matters. Also, if I'm drowning, but I need more resources, then this is quite an opportune time to build a business case for next year's organization and hiring the right folks. Bias for action, rather than endlessly spending a lot of time analyzing something and getting stuck in the mud through analysis paralysis. Sometimes 70% of the information is good enough for you to operate with. Third is focus on the end user experience. Where can I drive better communication? Where can I drive better planning? Making sure that my team is enabled to do well. So office hours, I provide videos for how to do something and try to get my organization to be as self-serve as possible. Fourth is enabling the business to take calculated risk. So where are we using the data? Where can we use third-party data for us to have informed decisions? Ruthlessly prioritizing. So this is where you take stock of all the projects through an intake process, have a prioritization framework. I use the effort impact matrix quite a bit. And that's going to give you a leg up in understanding how to prioritize your time. And then making sure that in your operating rhythms, you anticipate what your leaders are going to ask, and having some pre-analyzed answers to it. So for example, I know a lot of the questions that my CRO is going to ask in forecast and pipeline calls. I already prep ahead of time answers for those just in case. And then every meeting has to have an agenda. If there's no agenda to a meeting, it's probably a meeting that should be cut, because quite frankly, people are just showing up, wasting time. You want to make sure that you show up to every single rhythm with a clear focused agenda. Now, your operating rhythms. These are the things that should have those agendas, obviously, but each of these have a specific purpose with very little to few overlap. So design your operating rhythms in a way that you outline what are the specific operating cadences, what are they used for, how frequently they should be held, who the single-threaded owner is, who should participate, and when are they held. And make sure you do a time accounting exercise that certain roles in the company aren't bogged down in meetings all day long, even with this structure. So find the balance: sales reps under 5 hours, SDRs under 3 hours, leadership hopefully under 10. But it rarely ever works out for leadership, but please protect your sales reps and your SDRs time. The impact effort matrix I talked about, when you're prioritizing projects, you take the landscape of all the intakes that you have, put them on one of these 2 quadrants. You want to focus maybe 2 or 3 major projects per quarter. Try not to take on more than you can chew. Otherwise, you could be perceived as someone that is not pushing back or is performing at a subpar level. Thankless tasks, you want to automate those as much as possible. And you want to identify quick wins. Quick wins are going to be a great way for when you step into a new role or you have a new stakeholder to build that personal credibility within the organization that you can be seen as someone that's trustworthy. So talk about the intake form, effort impact. We're taking all the projects from across our stakeholders. We layer on the impact effort matrix in the form of 2 columns. The 3rd and 4th column, revenue impact estimate and project time. This is going to be your personal attempt at identifying what that's going to take in terms of manual hours, and then prioritizing them in one of those 4 quadrants. This is going to allow you to then determine which projects you can fund in terms of personnel and resources. If it's just you as a team 1, then you're obviously going to have just your name on there. But if you have other team members, you're going to have multiple team members. Here, which team members can take on which projects. You want to assign them to those projects and then identify which projects are going to be bottomed out, which you cannot fund. Here, I've marked one of those projects in red, meaning that we just don't have the skill set in-house to take on this specific project. It's not that we're being obtuse or to obfuscate with our organization. It's just that we just can't take on this project without an additional investment or resource. So you take that into account. You might do a little bit of horse trading. So you can see that one of the accounts that we said we could fund is now deep in the red. And that's because we started to have a refined conversation with our stakeholder, and they've identified that it's not actually a quick win or meaningful to the business. So once you go through all these projects, you want to set yourself up for transforming your organization in a way that they can absorb those changes in a good fashion. There's 2 forms of change management. One is adaptive, one is transformational. I won't go too much into change management, but there are a couple of frameworks that you could use in order to make sure that you have a clear process that you use to have the team have high adoption with your new changes. 5 steps to change management. Prepare the organization for change. So pre-communication, letting them know ahead of time. Crafting a vision and planning for the change. So give a pre-read or a PRD out to your organization. When you're implementing the changes, this is your design, your configuration, and your testing. You want to embed these changes with your go live and making sure that they're actually incorporating it as part of their processes, and then revisit progress 30, 60 days post-launch to see what adjustments you might need to make. And that's it. I want to thank every one of you for joining the lecture. I basically smashed 2 lectures into one. If you were curious about checking out the sales ops course down the road, I hope you do. It's 12 weeks, 6 lectures, and we go a lot deeper in the sales ops. But I'll see everyone next week for office hours, and apologies for the brief pause in the lecture, but I'll see everyone for office hours next week.
Thank you.
Cool.
Great.
Thanks everyone.
Jeff.
You see it.